So we have some questions about long and short strategies on strategy from an options perspective, and just some thoughts on a metal that isn't silver or gold today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. I apologize again that a week ago today I was unavailable because I was in Florida, as some of you will know. But we got some questions about winter, which is the YieldMax bearish options overriding strategy on Strategy Inc., which is the Michael. So we're talking about an option strategy on Strategy Inc., which is the Michael Saylor run company that used to be known as MicroStrategy, and also MSTY, which is the YieldMax covered call strategy on the long side. But before we get to that, I wanted to talk a little bit about copper, because obviously gold has had, I'll pull this up on my screen here, gold has had a tremendous run so far this year, as we can see, as silver has as well. Copper is also having quite a good year, it should be said. So that is the gold futures. This is going to be the front month silver futures. Copper is not a topic that we talk about that often. Now, it got into the news quite a lot. Not that, oops, did I put that right in there? You know what? I must have put the wrong ticker, so I'm just going to put in SLV, which is the ETF that tracks silver, which is close enough. Copper got a lot of publicity not that long ago because there was a lot of controversy about what went on in London with the copper futures market. And as is ever the case when there's a couple really big players and there are rule changes that maybe might have taken place that serve the needs or interests of sort of the big players, there's a little bit of unhappiness goes along with this. Cliff Asness of AQR. AQR is the quantitative hedge fund and value-based hedge fund based in Connecticut. Cliff Asness, a guy I have a lot of respect for, very thoughtful and very outspoken, appropriately enough. He certainly had some issues with the way that was handled. But I think the broader issue, aside from all of that, is what we think of copper generally. So what has propelled silver and gold to do as well as they have recently? I think it's safe to say that the perception of these as reserve assets for central banks and individuals is returning, or has maybe completely returned. That is to say that it appears that gold and silver are once again being thought of as money, and that fiat currencies not so much. So in that context, it's not that copper has necessarily sort of been thought of in the same way, although it has been used. So obviously we've had coins that were minted out of silver. We have had coins that are minted out of gold. And we've had coins that were minted out of copper. Pennies were, until the value of the dollar was devalued to the point that you could no longer mint them out of copper, because if you did, they would be worth more money as metal than they were as money. Same thing that happened to the other metals. And so now our pennies are 97.5% zinc, I believe, and only 2.5% copper, because it's just plated zinc. And now of course we're not making pennies anymore, because who needs pennies when the dollar's been devalued essentially to the level of a penny, which is essentially what has happened. So since the creation of the Fed and since we've been removed from the gold standard, the value of the dollar has gone down by 99% or so. So a penny today, or I should say a dollar today, is equivalent essentially to what a penny was, or even slightly less in 1913, or even 1925, 100 years ago. So the question now, though, is what do we think of copper? Now, the interesting thing about copper is that, of course, it has significant and important industrial use. And as we see a lot of, interest in things like Vistra Energy, SMR, which is NuScale, which is the small modular reactor company, everything associated with the data center AI trade, copper has also appreciated. But on a relative basis, it has not done particularly well relative to gold. So as you can see here, this looks like a pretty steady trend. And we are right now at, lows. This is 35-year lows of the copper to gold ratio. So my thinking is that gold has had a heck of a run. Silver's had a heck of a run. Maybe it makes some sense to take a look at copper. And in that context, and by the way, I don't know about speaking our own book, but we do own some copper in one of our discretionary funds. So Ulti is one of these funds. This is one of the funds where the investment team actually, it's not a passive investment strategy. So these are stocks that were selected specifically for it. On the long side, you will observe that Southern Copper is in here. And why Southern Copper instead of the arguably better known Freeport-McMoRan? And I think I've mentioned Freeport-McMoRan in the past. I don't know if I've mentioned it recently, but I thought we would just take a quick peek at the differences between these two because I think it's rather interesting. And one of the things you're going to see about Southern Copper is that, so here we are in Freeport-McMoRan. Take a look at this. All right, so this is the full year anticipated net income margin, about 8.5%. EBITDA margins about 36%. Looking at maybe 4% growth year on year for next year. Now take a look at the net income margins over here. 32%. EBITDA margins 61.9%. It's had better growth this year, as you can see. Next year's growth fairly similar. But, this is a business that is just operating much more efficiently than Freeport is. And if we take a look at the, at the multiple, you're looking at 24.5 times next year's estimated earnings, which puts you at roundabout a market multiple with an 11% growth rate. Decent free cash flow and free cash flow growth, but also supported by the fact that they mine a metal that is sort of critical to this whole new play, has a little bit of an inflation component in it. And so I thought I would bring this one to your attention. In our fund, in the Ulti fund, generally it's going to be long the underlying stock. There's generally a kind of a collared position on. Sometimes there might be a credit put spread in addition to a wider collar, and then short calls to the upside as well to collect premium. The objective here always being to be net short premium so that you always at least have the tailwind of positive carry. We can take a quick peek here and see which ones are actually selected, and you can see that it's just the December 19th 115 puts, and there should be some corresponding calls in here as well, which I probably scrolled right past. Here we are. And then you've got these 145 calls. For everybody who's watching, though, I would just simply say the following, which is that managing weekly call positions is a lot cumbersome. Let's be honest. You have a lot more gamma if you are trading it. So here there's a trading team that's more than 30 strong. Those guys can manage this stuff in real time. My suggestion instead would be, though, for the self-directed, home investor, if you will, probably want to look out a little bit further in time. And so I would consider just pushing this out. Yeah, I mean, you could go arguably to as far as February. Maybe you just want to go to January. I think either is fine. We'll start with January. I think that's a fine place to begin. Something like a call spread risk reversal, I think, is suitable. The 160s are a 17 delta. I'm perfectly happy to lean long, more long deltas here. So maybe something like this. Sell the 135s, or so you're looking at maybe a 5% discount to the current stock price that you would be potentially put the stock. It's had a little bit of a bump up in recent days. You could go down as low as the 130s. The wings are going to decay a little bit more rapidly. So even though this has a trade cost, a net debit of about $1.30 a share, as you can see here, I think this is still going to set up just fine. And the other thing I would say, and we'll see how it opens tomorrow, so the prices may be a little bit different. If you push it out by another month or so, you'll see that you'll actually get to a modest credit. This is at the mid-market levels, but you should be able to put this on probably for even. Now you could potentially put the stock at 130, which is, call it an 8% discount or so to the current stock price, and get $15 worth of upside participation, and probably some standstill rate of decay. But, I think it's a good place to be, reasonable valuation, and it's, it's operating at better levels in terms of their margins and so on. This is, by the way, I should also say this is it's a subsidiary or a partial subsidiary of Grupo Mexico. Operates principally in Mexico and Peru, but we talk about gold, we talk about silver, we talk about other commodities. I think copper might be something to take a look at. So just wanted to offer that out there. Okay, so now there was a question which I thought would be interesting to tackle. Are we able? I will ask the crack production staff. Yeah, can the Slack question end up on screen? Oh, it's on screen. Great. Okay, so I don't see this screen really well, so I'm going to read it off of my screen over here. Can you cover the YieldMax philosophy of selling calls or puts on the full portfolio on most of its funds versus the different strategy on its new lower yield target funds? And we're going to cover the second part of the question first. I bought Winter on August 11th, 2025. Okay, so for those who don't know, Winter is the bearish strategy. The bearish strategy covered, option overwriting fund that YieldMax runs. So it takes a bearish tilt on strategy stock, Strategy Inc., MSTR, and sells options against it. MSTY is another fund that YieldMax runs that takes a bullish position on Strategy Inc. and sells options against it. And actually, we'll bring up all three of these. So we'll do Mr. as well. So you did this on August 11th of 2025. And let's just take a look at MSTY for the sake of argument from the same date. Okay. So how are we doing? First of all, let's take a look at how strategy is done. I don't think this is going to come as a surprise to anybody. Bitcoin has not done particularly well in the latter half of this year. Strategy has done even worse. Strategy topped out on July 16th and is down sharply since. Here we're looking at August 11th because that is when this viewer happened to have purchased it. Strategy has fallen 54.1% between the close on August 11th and the close today. All right. MSTY, which is long the underlying stock and selling covered calls, if you had taken the distributions from that fund and reinvested them back into it each time you got them, since August 11th, That was down, or is down 48 we'll round up 48.93%, or down 43% if you had just taken those distributions and put them into cash. So an unhappy circumstance to be buy writing a stock that has declined, but it's been better to be buy writing it than to buy the stock, because at least the call premiums you've been collecting have offset some of those declines. I think maybe we'll just, for the sake of argument, well, we'll look at each of these. Strategy doesn't pay any distributions, so 54.1% we can compare that either to 43%. So this is outperformed by 11% since August 11th on that basis, and obviously slightly less if you had reinvested the dividends. Winter is up 58.8%. If you had not reinvested the dividends. This is the remember, this is the bearish one. So it is up by slightly more, I think. Yeah, so it's up by 4.4% more than strategy is down if you did not reinvest the dividends. And if you had reinvested the dividends, then you would be up 69.75%. Versus the decline of 54%. So this is 4 months, basically. It's not quite 4 months, but almost 4 months. It has, the bearish overriding strategy has outperformed a short position in strategy itself by anywhere from 4.4%, 4.7% if you did not reinvest the dividends, to as much as 15% in 4 months' time if you did reinvest the dividends. Now your question is, I bought winter. Okay. Well, actually, the first part here, I just wanted to just address this quickly. If you'd shorted MicroStrategy on that day, or strategy on that day, I'd be up 113%. No, I don't know. No, you wouldn't. If you'd shorted strategy on August 11th, you'd be up 54%. Based on your comment that you made 57%, which I assume, I'm not sure exactly what level you got in, so that suggests that you just simply took the distributions. So yeah, you did better off buying winter than you would have been short strategy. Had you reinvested the dividends, you'd be up even more. The next question, though, what's your guess as to what my return would have been if winter had been a target 12 or target 25 fund? Well, the first thing is that the target 12s pay monthly distributions of 1%. So very simply, we can see here that in winter's case, over this period of time, the distributions were 40%. I'm getting, this is approximate, but that's by taking the total returns, which are in this line, 58.8%, and taking a look at the appreciation in the winter share price, which is 18.5%. The difference between those two is approximately 40%. So this is paid approximately 40% in dividends since this point. If you had had it as a target 12, you would have gotten 4% in distributions because it's approximately 4 months, right? So you've gotten a 1% distribution each month. So then the next question is, well, how much would it be up in total? Well, it would have been short the stock, which is up about 54%, which means that in total your returns probably would have been, give or take, my estimate is going to be this plus the 4% in premium that you're looking to collect gets you to 58, which, as it happens, is about the same. So essentially, in a target 12 environment, this actually would be very close to what you got anyway. So your total returns are close to 60% in 4 months. You still would have made approximately 60% in 4 months in round numbers. The difference is that instead, you would not have gotten the same kind of distributions, right? So you would have had much lower distributions, 4% instead of 40%, but your returns would have been about the same. So that's as a target 12. And as a target 25, it also would have been approximately the same. Now, and it just would have been a rebalance of the distribution. Now, you're probably asking yourself, you're saying, well, what difference does it make then to be in a target 12 or where you're taking distributions of 1% or 25 where you're taking distributions of approximately 2% a month versus something that's maximizing the distributions? The situation here is that MicroStrategy is uniquely easy to model in this circumstance, and here's why. Because if you take a look at the performance of the stock, it's almost a perfect line straight down. There's a little bit of a boost that took place in here, but generally the stock has not done something crazy. It hasn't been going like this. It basically is going from the upper left to the lower right. So it's almost ideal for an overriding strategy. You know, if you think about what you want for an overriding strategy is you want to get the direction right on the underlying, and then you hope that it goes between then and some future date. So if it was a bullish strategy, you're hoping that similarly it does so in a very steady manner, because now you're going to benefit from the thesis that you had on the underlying asset, which in this case was bearish. Well done, by the way. So you only missed top ticking it by a little over 3 weeks. So very well timed. And the other is that, you know, you're going to collect some premium along the way. So in this particular case, because the stock did not have really wild moves and it basically just trended lower, it doesn't make as much of a difference. Bear in mind that the target 12s, like the slightly lower payers, will tend to use slightly longer dated options. The rate of decay of near dated options is more often than not going to be higher than the rate of decay in longer dated ones, but you have more gamma exposure. So, and gamma is just basically the second derivative with respect to price. So we don't like being short a lot of gamma when stocks are whipsawing back and forth. That is suboptimal. So yeah, in this particular case, it's a little easier than it normally would be. If we had something that had been behaving a lot more choppily than this has, doing an analysis like this would have taken a bit more time. Okay, so I hope that helps you. Let's take a look at some other questions. Steve Garcia. If you recall, I recently opened a strategy DIPS put ratio spread, the 162-180 for a $2.90 credit. I can now sell it for $5.20. The short puts decayed fast. Should I close the trade now, or maybe just the naked put? This is actually, what's nice about this question is that you are now getting into this gamma situation that we were just talking about. And the same thing we were talking about with copper. So this question actually suits a couple concepts that are here. Number one, I'm not enamored of getting into the really short gamma situation because now you're going to be potentially forced to do something because your position's going to have a lot of convexity to it. So I would say, yeah, go ahead and take your profits now because this is December. I'll say that this is something that Tom Sosnoff and Bat talked about at Tasty and before that when they were Thinkorswim, and that is that there's a balance that you want to strike between the accelerated decay that short dated options offer and really dollar cheap options, just trying to pick up the last few cents. I don't think it really makes much sense. Some people just play them all the way to expiration. Friends of mine like Carter Worth will tend to do that. We do that in another context. So we have a product we're going to be launching very soon, which basically is going to throw out a lot of short premium trade ideas each day. And the idea is that those are strategies that one could just put on and set and forget. That doesn't mean that I wouldn't prefer that people close them early, but they're designed so that people can set and forget if they want to. My thinking is that, you end up in a situation where, let's see if I can, it'd probably be easier if I had a way to just do, I'm going to do this, okay? Because this will make it a little easier to illustrate. So I'm going to draw this. Okay, so we're going to have, this is the rate of decay. So decay, your theta, which is the rate of decay. I apologize because my drawing with a mouse is terrible. So theta is here, and on the x-axis is your days to expiration. Okay, so we'll just say infinity is over here, and we're going to say that 0 is over here. So this is expiration day right here at the intersection. Okay. Now, options, as we know, all else equal, options decay is higher as expiration approaches, but only to a point. And why is that? Because right at this point, when they get really cheap, you're dealing with options so cheap that even though they might be decaying at an infinite rate, who cares about the infinite rate of decay on a 1 cent option? Relative to your risk, this spot in here is not a great place to risk your capital. Okay? In fact, that infinite theta could still be less than, relative to the price of the underlying stock, could be less than the risk-free rate. That to me is unacceptable. Put differently, I have no interest in being short options where the amount that I am being paid to be short options is less than I would earn on a cash balance relative to the notional value of the underlying. Because in the event that some catastrophic thing takes place, why would we ever take that risk? So, example, I'm short a $100 strike put, one of them. So that means that I have the risk of taking on $10,000 worth of stock. Am I willing to be short that option for any length of time for a penny a share? So in other words, am I willing to take, if the stock went to 0, I would lose $100 a share. Am I willing to be short that put at a penny? Well, if the risk-free rate is 4%, then that means that I'm expecting to make, 4% annualized. But you could say, well, with an hour to go, a penny is arguably more than that 4% risk-free rate. But if I was looking at it a week earlier and that thing was a nickel, it wouldn't be. So what's my point in all of this? My point is that when the amount of time to expiration gets very short and those short options have decayed considerably in value, take them off, because the way to think about this is, can I redeploy that capital elsewhere in a manner that is more favorable? And the answer to that is almost certainly yes. So, yeah, I would take that trade off and move on. Steve Garcia, I'm really digging this trade setup. Yeah, I mean, I agree with you. I think it's a good strategy. You're taking advantage of the fact that the wings will decay more rapidly. Let's take a look at this. So we're going to go, let's go out to, say, January. Go to January regulars. And the important point to make here is the theta. I'm going to go like this. Let's see here. Go to 170. I'll just get this centered over here. All right. So your theta is this number over here. So you can see that this has a lower theta than, call it the 180s, which are here. You're using a ratio. But as a percentage of the value of the option, this is where you can see how this works, right? So this is a nickel difference in decay. This one's 22.5. This is 17.5 cents. So there's a 5-cent difference in the decay rate. So, this one's about, we'll call it, it's almost 22% less decay. But this option does not cost 22% less than this one, right? It costs much less than that. So this option, as a function of its own value, is decaying much more rapidly than this higher strike option is. And now what happens is if I buy that 180 put, and so I spend, let's just say $15.50 to keep it easy, and I sell 2 of these at, call it $6.30, right? Those are decaying at, in this case, it's 17.5 cents, so it's 35 cents a day, and I'm long this other one, and I'm losing 22 cents a day, so I'm really making 10 cents a day times 100, right? So I'm getting $10 a day to put on that strategy that is going to make money anywhere, in this particular example, anywhere. So this is 180 to 154. This is really going to get me put the stock when the difference between these strikes, it's going to cost me $3. So, and the difference between the strikes is $16, is $13. So basically the downside break even on this trade is $141, right? $42, more than $42 lower than the current stock price, which is a decline of 22.8%. So I can see why you would like this strategy. That's the thing to keep your eye on. And when this relationship, when these things decay so much that current tailwind, where you're getting $10 a day, you're getting paid $10 a day to have that trade on, at a certain point that's going to flip, and you're going to find that the decay rate on those 2 options is no longer greater than the decay rate on the one. That would be a good time to adjust it. So, hope that helps you. Okay. Hi, Mike. What's your comments about Warner Brothers taking the takeover between Netflix and... So this is an interesting thing. Let's talk about this. There's a lot of options trading that goes on in what we call risk arb. What is risk arb? Risk arb is merger arb. It's another word for it, although it's sometimes used in other corporate action contexts. So what's happening here? A common trade that is used by the arbs is to get long the target stock, short target stock upside call options, and short the acquirer. So in the context of Netflix buying Warner Brothers, that would mean long Warner Brothers, short Netflix, and then short upside calls in Warner Brothers. Which calls do you sell? You sell the calls that are closest to the strike that represents the takeover price. Now in this particular instance, the deal was, I think, $27 or whatever. What was the valuation exactly? Let's see what the deal was. And it was supposed to be some stock and cash. We did see some of this activity last week. Why is that not? Normally that's in my CAX function. I'm not seeing it there. So $23.25 in cash. So it's virtually, and $4.50 in stock. That was the deal. So that works out to $27.75. So in theory, Warner Brothers, and this actually, there was time to do this trade. I was kind of surprised that more people didn't get into it. There was some activity on the DEAS-27 calls, a lot of it last week when this came out. But, yeah, the common trade would be sell the 27, 28 strike calls, which exactly what's going on here. So you buy the stock to milk the last few pieces out of it. Let's take a look at these Jan 27s. So for example, or these last couple of days, you could have sold those options, or you could sell them now for about $1. All right. And you could buy the stock, which I think is right around 27 the figure, right? $27.23. Ooh, it went up to $28.16. Okay. And that may not seem all that appealing. You're saying, okay, well, you could have bought the stock for, call it $26 on Friday, and then sell an upside call for another 80 cents or something like that. And you say to yourself, well, how great is that? That doesn't seem all that terrific. Well, think about it this way. So that means that you're going to get $1.75 plus another 50 cents, let's say, is $2.25. So $2.25 on a $26 stock at the time means you're going to get 8.6% return. And you're saying, well, 8.6% doesn't sound all that exciting, except that it's a pretty safe return. Right? The deal's out. They had accepted it. Maybe somebody else comes along and there's a better buyer and there's a huge breakup fee. So even if the thing falls apart, Warner Brothers is going to get this huge chunk of money. And there's a $5 billion breakup fee or something like that. So that's sort of how the ARBs would typically play this. What are my thoughts? I think, I was looking at this. People may not be all this enthusiastic about the following, but let's just say that I suspect there are some synergies. Synergies is, I guess, a euphemistic way to say is there could be some cost cutting that could go on at Warner Brothers. Warner Brothers has more than twice the employees that Netflix does. So Netflix has, and not everybody is going to be, we've got 14,000 employees at Netflix. Warner Brothers has got 35,000. It does feel to me as if Netflix could get more out of Warner Brothers than Warner Brothers is getting out of itself, if you will, as an operating concern, if we think about it this way. I'm not an expert on their business, but I'm going to assume that they could figure out a way to get some operating efficiencies. So let's assume that they do this. This is not a profitable company, or at least it's not forecast to be in 2026. But let me ask the following question, which is, do we think, let's look at the SG&A, right? I think this is one way to think about it. Do we believe that this is a company that could pull down their SG&A by, let's call it, $1.25 billion? So this is just the trailing 12 months, but do we think that they could pull $1.25 billion out of SG&A? I would assume that within 18 months they could do such a thing. If they did, then where does that get the company 24 months from now? And I think that, you do that, you're going to get their EBITDA up to, call it 10. Netflix is at an EV/EBITDA right now. You can see right here just how big a spread that is. So call it 17 to 47 to 417 billion. So based on that, just sort of basic arithmetic, gets us to $27 billion worth of EBITDA. Do I think it deserves that same multiple? Not necessarily. Let's use a much more conservative assumption and say, okay, I'm going to trade 20 times EBITDA. Not the number that it's trading right now. So right now it's 418 versus 17.2, 24 times. So a 20% discount to the turn still gets us to a $540 billion enterprise value, which is considerably more than they're spending to buy the company. Now, this is really hand-wavy, back-of-the-napkin kind of stuff that I'm throwing at you here. But that seems very realistic. also, right? I mean, just sort of work through it yourself and say, okay, well, if Netflix were to acquire Warner Brothers, are they just going to let the business run the way it has been? Or are they going to do some stuff to make it more efficient? Is there any, crossover in the grand total of 50,000 employees that the two companies collectively have? And the answer is almost certainly yes. Now, I don't know exactly what those synergies are going to represent, but I'm sure they're significant, and they're worth a thing or two. The companies are worth more money together than they are apart, which, by the way, is one of the reasons I suspect that people are looking at this thing and saying, okay, is there going to be some kind of antitrust concern? I don't think there should be necessarily. We do know that Donald Trump has said that he was going to weigh in on this, that he was going to be involved in some way. Don't know what that means, but yeah. And look, this is also a marquee property. So, and this is a business that, marquee properties tend to generate a little bit of time and attention. These are businesses that people like to own. There's a little bit of prestige associated with it. Fame comes along with it. So, I'm not terribly surprised to see this additional, maybe more of a bidding war in some ways going on than people might have even thought possible not that long ago. So now you've got Paramount out here, trying to bid even more money. It's interesting to me. So imagine you're Warner Brothers and you're saying to yourself, okay, do we sell to the highest bidder? The board's looking at this saying, do we just simply sell to the highest bidder? Or do we sell to a sustainable bid, right? Warner Brothers as a business, let's just take another look at their financials, okay? So Warner Brothers as a business, this was not a business that was expected to actually be profitable next year. Positive free cash flow, which is good, supports a decent bit of debt, but not necessarily going to be profitable. Then you take a business like Paramount as the potential acquirer, and we take a look at their financial picture and say, okay, well, what kind of a situation we got over there? So we got $1 billion of net income, not a whole lot. Oops, wrong one, sorry. Wrong one. It's not a tying two rocks together to see if they float. This was a joke I made many years ago. Many of you watching right now probably never heard it, but many, many years ago, Microsoft was going to acquire Yahoo. And at the time, my brother-in-law worked for Microsoft. And he and my sister were friends with people who worked at Yahoo. And it was the early days when I happened to be on CNBC. And I was being asked what I thought about Microsoft acquiring Yahoo. They had made a bid, and I said, I think it's a little bit like tying two rocks together to see if they float. This was not a comment that was taken well by the folks at either Microsoft or Yahoo who heard me make that remark. I just didn't understand it. I couldn't really figure out why Microsoft needed Yahoo. I could figure out why Yahoo needed Microsoft. That made perfect sense. Yahoo was already long since losing the search battle to then known as Google. It became Alphabet later. But I couldn't really figure out why it was that Microsoft needed Yahoo, so I just didn't get that one. In any case, I can understand the synergies between all of these businesses. But if I was selling the assets with the hope that the company would be in good, strong hands, I would have to say that I think Netflix is the stronger set of hands into which it could fall. My 2 cents. You guys by all means, chime in and share your thoughts on that. But let's take a look at their financials here. I mean, this just, I don't know. I mean, you want the grower, as far as I'm concerned. It's probably a better way to play. So, that's my... Okay, so Alex, 659, traditional question. Will Lulu's report be good on Thursday? So Lulu, which was a long-time Holly Index name, so named because I used to, still do, check out the American Express card to see where the money was being spent. For a long time, Lulu was a perennial on the Holly Index list up until about 2 years ago. And I actually mentioned this, especially around the Christmas holidays, because my wife has a tendency to buy things for herself around the holidays and for other people at the same place. So, conveniently enough, right? So she started to really like Vuori. And I noticed that during the holidays, the gifts that she was purchasing for people no longer came from Lulu. And on the shoe front, they no longer came from Nike. So she was buying ON shoes and she was buying Vuori. And Vuori is not a publicly traded company. So I couldn't add that to the Holly Index list. This one has not really completely recovered. I think it has gotten a lot cheaper, which is a positive. And the real question is this number going to hold up? It fell below sort of my high level growth target to be sort of one of the stocks that I would look at on the long side, because remember that I want to see the top line growing faster than, just to be considered, because why would I buy it before I buy something else unless it's like a special sit, a circumstance where it's just gotten so cheap we have to really wonder whether we can put it into a different sleeve of our investments where we're just saying, okay, I just like it because it's gotten so cheap, and I'm willing to take a flyer and violate. We're making exceptions. That's what we're really doing, right, when we do that. So the top level growth has fallen below not only what I think the anticipated top line for the S&P is for this year. I'm not 100% sure that it isn't below the real rate of inflation. So it's above the headline rate, but it might be below the real rate. So that's the first thing. Second thing, EPS growth. We're not really getting any. So that's the bad news. But leaving the bad news aside for just a moment, let's just take a look at what the alternative data has here. And as you guys know, I like to look at Placer AI. So this is what we're getting. So what does Placer do? For those of you who are watching who don't know, there's different types of alternative data one could look at. And people do all kinds of interesting and creative things. So, for example, for a while it was really well publicized that there were people who were analyzing satellite images of parking lots outside of malls and then trying to figure out where all the cars were parked. Like, are they close to the Sears end? Or are they close to the Macy's end? Is it more than there typically are and less? Placer is taking a similar approach, but it is a lot more precise, because what Placer does is they've got millions of mobile phones that they can track, and they can see where these things go. And they can see how much foot traffic there is. And if you take a look, you're going to notice something, and that is that the foot traffic into Lulu is much better than the foot traffic going into other stores within the same industry. So that's measured here. I have also previously said that I actually have had better experience following the Placer AI data than Bloomberg's second measure. Now, bear in mind that Bloomberg's data is, that's going to be, I'm sure they're steadily improving their process. and in fact, I didn't even look at this before because it wasn't even a thing, but it's probably getting a little bit better. You can also notice that SimilarWeb, look at this. Their web traffic is also much better than the industry overall. So relative to their industry group, that's a positive. I would like to throw out the following caveat to all of this. I don't know how big the impact of this is going to be. Any of you who have an American Express Platinum card probably know this. American Express revamped the benefits that come along with holding a Platinum card. And some of their other cards too. I happen to have a Platinum card, so I don't know what the other ones are. But what I do know is that they have a couple things that they include. So for example, and I apologize, this is long-winded, but there is a point to it. For example, you can get $100 credit at Resi restaurants. So if they are on the Resi platform and you make a reservation, go and eat at the restaurant, and then you use your American Express card to pay, and you've registered for the program, once a quarter you can get a $100 credit back. Well, I bring this up because they also have credits for Lulu. It's a $75, I haven't used the thing yet, but they have like a $75 credit. I have friends who have these cards. These same friends have actually gone into the store and used the credits. This is relatively recent. And when I say relatively recent, this is something that is within the last 4 to 6 months. I became aware of all of this just a couple of months ago. I've actually used the Resi credit for this quarter, for example. Again, like I said, I haven't done anything with Lulu. The reason I bring all of this up is that I don't know how much of this boost that we're seeing here is a function of this. There are, of course, a lot of people who hold American Express cards. And I'm going to assume that if you have an American Express card and you get a $75 credit to shop at the store, you're probably going to use it, right? Because you lose very... Well, what are you going to... I mean, Lulu stuff, you probably not a lot of stuff in a Lulu that costs less than $75, but even if you could find something that costs $125 and you get it for $50 because you got a $75 credit, you're probably going to do that. There's probably something good enough that it's a good price. Lulu wins because, you go in, chances are maybe you get more than that. So that's the one thing I would say on these uptick alt data numbers. So that looks very positive. I like that. The price action is terrible. So that's I mean, it's not ticking a whole lot of the boxes because it's below the long-term average. Let's also take a look at some revisions, because I'm guessing there have been... The price action suggests to me there have been some negative revisions in this thing. So, revenue, yeah. So, on balance, over the last 3 months, revenue assumptions down 0.4%. Full year EPS estimates down 0.1%. That's just within the last month. Over the last 3 months, the full year EPS change is down 3.1%. And if we look at the quarterlies, and that's where a lot of this appears to be coming from. So this is just looking ahead at the quarter. Negative revisions. And for those who are wondering, these are typically not associated with really positive results a month later, it should be said. Okay, so now that we've got all that out of the way, what do we think of the stock just in terms of valuation, assuming that they can stabilize things? So we have this balance right now. We've got sell side, they're bringing their revenue numbers down. They're bringing their EPS numbers down. It is clear that their growth rate has slowed. Technically, it looks bad. Boy, it all sounds really awful, doesn't it? But meanwhile, we have Placer AI data and other data and the SimilarWeb data, which shows big upticks on a relative basis compared to the industry overall. which may or may not be related to benefits that folks like American Express card holders receive. On a valuation basis, let's just take a look at it versus next year's numbers. And actually, let's go out a little bit further. So there, right now, the market's still looking for a recovery. But right at the moment, the consensus is for $12.84 in adjusted EPS for full year next year. When's the last time? And, remind yourself of Nike, by the way, because when consumer names like this start to founder a bit, oftentimes, in my experience, people do not take their estimates down fast or aggressively enough. Okay, but leave that aside. Let's talk about some of the positives. Some of the positives are that a lot of retail has actually done really well since November 20th. I think I talked about this last week, but if I didn't, I'm going to bring it up right now. The performance that we've seen in XRT, which is the retail ETF since the 20th, right in here, this is one of the best bits of performance in retail since this thing was created in 2006. We're up 11.4% in, basically 2 weeks' time. This is like a 98th percentile kind of a move. We've gotten a lot of very decent results out of those companies that have reported. We've gotten decent results out of companies that we probably would have expected would have been miserable. DG, which is not at all related to this, but Dollar General is an example. It actually got me wondering, are consumers maybe a little better off? Because I've been saying a lot of things about consumers where I thought they were pretty hard up based on things like auto loan delinquencies, credit card balances, cash balances in the lower half of the income distribution. All of those things seemed pretty negative. But yet the sales numbers have been a little bit better than expected. Now remember that surveys showed that the median household anticipated spending budget for this holiday season was something like $120, $130 less than it was in the year ago period. But the results that we're seeing coming into this most recently reported quarter indicate that it might actually not be as bad as all that. So as we look at that, then you say, okay, well, let's discount the numbers that the street's looking for next year. So the street is expecting, so this is actually next year's number, not the 1290, because you'll notice that their fiscal year actually goes to January. So this is really the 2026 calendar. That's 1284. They made 1258 back in 2024. Let's just say for the sake of argument that it actually goes back to here, 971, right? And I could just as easily, to keep the math easy, just say, how about $10 a share? But that's 18.8 times at 971 if they could come off of that number. To get to a market multiple, let's call the market multiple 22. So where would they need to get down to? That's $8.30 a share. So that's halfway between 2022, 23's adjusted EPS. They're pricing in a lot of bad news here. Positive free cash flow. In fact, their free cash flow numbers are very close to their net debt. As you can see, and not their net debt. I misspoke. Very close to their aggregate debt. They actually don't really have much net debt. $500 million or so, but in the grand scheme of things, that's really not much. It's getting in there into the special sits territory, where we say, okay, you know what? It's getting pretty cheap. And maybe it sets up for a little bit of a barbell. We can see we had a couple bad earnings results in here, and the stock fell a lot. But it was falling from much higher valuations, right? See? So now we're at about 13 times. But in this entire region, the stock was substantially higher than it is now in terms of its valuation. So yeah, you know what? I mean, especially based on the second on the alt data, I think maybe a speculative long here, not a bad play. Let's see, what's the implied move? We got 10.65. So let's see. You know, this might be kind of like a call spread risky play. I would almost be tempted. Yeah. Almost be tempted to do like a ratio call spread. Long 1 and short 1.5 to 2 to the upside with the hopes that. But this thing can obviously really swing around, and maybe that's just getting a bit too greedy, little, you know, what do we call it? Too smart by half. So I think maybe a call spread risky isn't a bad way to play this one. Let's see how maybe a Jan sets up. Normally, now look, a call spread risk reversal has a lot in common synthetically with you know, a buy right or a short put, something like that. So normally I'm not super enamored of getting short options into an event. A call spread risk reversal is kind of pushing things around a little bit. You're squeezing the balloon so you can get a little near side, upside exposure. We've got elevated options premiums. I'm not sure that they're quite as, I mean, given the moves we've seen, I'm not sure that they're as elevated as they might be. Well, first of all, let's do this. That should be 185s. Maybe even a little bit higher. But let's just take a look at where the break-evens on this one fall. And also give some thought as to... So this thing, so much like the passage of time, we were talking about how the wing options on that 1x2 that we were talking about earlier, those decay a little bit more rapidly. These wings are going to come in due to the vol crush. So, you know, the downside risk here is that you're really getting long the stock around 165. Maybe a little, but we'll just call it 165 again to keep the math easy. So that's a discount of 10% to the current stock price. Is that enough of a discount? I don't know. I should probably, you know, they say phone a friend. I should probably phone my wife and say, "Are you going to shop at Lulu?" But I already know the answer. She's going to Viore. The Viore is like, it's like 200 feet away from the Lulu close to us. And I already know the answer. She's like a huge fan of Viore. By the way, I'm not 100% sure about Viore myself. I don't know what you guys think. It just seems like expensive pajamas. When I pick up these sweatpants, I'm like, I mean, do they look great? I'm not sure they look great. I don't get it. But you know what? What the heck do I know? I get most of my clothes off the tables in Costco. So it's one of those things. You know, you get to a certain age, you just stop caring. I can still remember thinking my own dad, like, where does he get his clothes? Why doesn't he buy decent clothes? Then now I know. You just stop really caring about that kind of stuff at a certain point. Okay. That is that for Lulu. Hi, Mike. Been quite a ride with Oracle since the last earnings report in September. What do you think about the upcoming report on Wednesday? Long-term holder. Feels a bit to me like the damage to Oracle has been overdone, but I would like to point something out because I was looking at this last week, and that is the debt and cash flow picture. So a lot of these companies that are investing heavily, they don't experience this situation right here, right? So we're dealing with a period of sequential negative free cash flow that is growing. I get it. Making an investment makes sense. But this company also carries a good bit of debt, right? So we're closing on $100 billion worth of debt. And this is, I look at these numbers and I think, okay, I can have that, or I could have something like, I'm not saying these things are exactly equivalent, they're not. But I'm just looking at the numbers, and we're all going to look at them together. Or I could look at something like this. And what am I looking at? This just seems like a happier picture to me. We've got massive free cash flow, a massive amount of net cash. You've got about $60 billion worth of net cash here. And, you can put your money in one place or another. That said, Oracle has been really badly beaten up. So let's see whether there's any technical indicators that give us a sense that maybe now's the time to try to catch it. It actually caught a little bit of a bid today. So the best performing technical indicator for Oracle, and not by a little, are the stochastics right here. This is how this has timed this trade. It's timed it very well. And it was a seller over here back on the 20th. Very well timed, it should be said. And it is a buyer here. Cover your short and go long. So from a technical standpoint, it appears to be a decent juncture, at least by the best performing technical indicator for this stock. Okay. David, assuming at some point in the future Bitcoin will achieve a new high, is it a valid point to remain in MSTY and think of reinvested dividends as a dollar cost averaging at a lower level? Yes, I think so. I was saying this earlier. I'll say it again. I'm assuming so somebody was asking me this question. Do I think that Bitcoin's going to go to the levels that Cathie Wood has set, which is like $1.5 million? And I said $1.5 million means that the value of Bitcoin is the same as the U.S. economy. Because there's 21 million Bitcoin times $1.5 million gets you to just over $30 trillion. That's about the size of the U.S. economy. By 2030, by the way, is her objective. Like many things she says, there's an awful lot of optimism baked into that cake. I'm not quite there with her. But am I bullish on Bitcoin, and do I think it's going to be higher in 2030? And the short version to that is, yes, I think it will be. And the reason I think it will be is because of what we see in gold, because of what we see in silver, because of what I believe we are seeing and will continue to see in copper. Because I think that the problems with a lot of, fiat currencies will persist, and people are looking for something that is a better store of value. And Bitcoin has a lot of things going for it that other hard money proxies do not. It's fairly clear by the acquisition of gold and now as a follow-on to that, silver, that people are looking at precious metals as money again. The disadvantage is that that's not so handy for transactions and transportation as Bitcoin is. The example that I provided in conversation I was having with somebody earlier was that I was in New York City when September 11th happened. And on that day, for those of us who were in Manhattan, we were thinking, boy, do we want to stick around for this? Jets were flying overhead. You could smell the fires if you were close to them from the World Trade Center. It smelled like burning plastic. National Guard and police were blocking off the streets. I'm thinking, well, maybe we don't want to be here. And so I thought, well, perhaps I'll get out of town. So my girlfriend, who lived in the same building at the time, I got my car out of the garage. I went to go get some gas, and they weren't taking credit cards at the gas station. Said, no, we're not going to do that. You got to pay cash only. It's like, ugh. So got back in the car, went over to the nearest Bank of America branch, and at the time that branch would only let me take $500 out. I took $500 out, and immediately an announcement came over the loudspeaker: we're no more withdrawals. So whoever came in behind me, they didn't get any money. And I remember thinking to myself, whoa, this is what kind of a world are we living in? I went back to go get cash, but by that time they'd closed the bridges and the tunnels, so we couldn't leave. But the more important point was that I understood at that moment that the conventional way of handling transactions under times of significant stress aren't necessarily what you think they are. Your American Express card isn't going to work if all hell breaks loose necessarily. So what will work? Well, cash will work. And I believe as long as there is some electronic network available to us, because that still existed, I think the ability to transact in things like, making Venmo payments might work. Maybe Bitcoin could potentially work. And gold is not the kind of thing that you can transport big distances. So if you're trying to, move money to somebody who's far away in a form that they can then use it, these are things that Bitcoin has. It's a secure network. You can transfer it over distance. Theoretically, a real store of value. All of these benefits to it remain, I believe. But the other thing I also believe is that folks are looking at Bitcoin and saying this is a disastrous pullback and they've never seen anything like it. Well, maybe they have not, but we all certainly have if you've been watching this as an asset class for a long time. And if you have been, the most recent drawdown is really pretty minute in the grand scheme of things. So this is a logarithmic chart, but, here we have it. So there's a decline of 81%. There's a decline of 85%. There's a decline of 84%. Here's a decline of, 77.5%. You get big drawdowns. So could we see a bigger one? Could we see Bitcoin get down to, for example, this lower fib that we've talked about in the past, like into the mid-70s? I suppose it's certainly possible. It's struggling in here. It's trying to find its footing. But that's, down in this neighborhood here. And if it gets down there, it's going to take strategy with it. That's going to be, we're at 90 now, so that's another 15. Let's just call it round numbers and say that strategy has, potentially 20% worth of downside from here in that event. But the flip side of all of this, as I've also said, is that strategy shareholders get not just the appreciation associated with their portion of the total enterprise value in the event that Bitcoin appreciates, but they actually, in many instances, are going to get at least the first bit of appreciation in Bitcoin that is ultimately going to be the entitlement of the debt holders. And that's because in many cases, the debt does not convert until much higher prices. You have $3 billion worth of debt that converts at over $600 a share. You have another couple $1 billion worth of debt that converts at $433 a share. So the total of $15 billion worth of debt, a third of it solidly doesn't convert until the stock's up, 150% from here, and that's the first $2 billion, and then you've got to get up to over $600 a share, so it's got to well more than triple from here before that $3 billion zero has any essentially entitlement. So you're getting that call spread. You get more leverage. That's what you get. You're getting essentially a bit of leverage, and I still think that Bitcoin recovers, and I think that if and as it does, strategy will too. I think it's going to participate at a rate faster. $1 invested in strategy should appreciate at slightly better than the pace of Bitcoin appreciation. And the reason it should do so is because strategy shareholders have those sort of embedded call spreads. And there's a little bit of leverage. So it's a slightly levered play. But it's a slightly levered play with the exception that if the whole thing went to zero, that's the most you lose in strategy. Whereas if you took a levered play in Bitcoin, you could conceivably lose more. So, yeah, there's that. If Yeah, Bronson. Okay, we're going to just get through these last couple ones if we can, as fast as I can. If you're bullish NVIDIA, what are your thoughts on long, for example, 2:1 ratio of NVDY and DIPS? I assume you end up with something similar to a long skewed strangle. Yeah, I think that's right. So just for people who are paying attention at home, you've got an overwrite strategy that's bullish and an overwrite strategy that is bearish. The objective, and you would say to yourself, well, why would you take both a bullish and a bearish? You know, the bullish and the bearish strategy, that worked out very well in strategy in winter. So basically a pairs trade in those things actually would have had, you know, since MicroStrategy peaked on July 16th, actually would have had a positive total return of about 9%, which is, you know, pretty good, we'll call it, for a 5-month stretch, or a little bit more. And, you know, the idea here is that you're not getting as long delta. So if it just sits here in the middle, there's a possibility that both could make money, right? And you're not as long. So I think that's totally fine. What else we got here? So John is asking, Lulu, strangle or straddle? I don't trade straddles pretty much ever anymore. That was something that I did when I was trading vol. So people would come in and they would buy straddles or sell straddles, and we would take the other side, and we would just trade the volatility by hedging the gamma, hedging our deltas regularly. I don't trade straddles as a rule anymore, not because I'm opposed to them, but because, as you can see, I'm really more interested in technical levels. So technical levels and fundamental levels. And a straddle doesn't have that. You're just basically picking the spot price. So unless you happen to be at some magic juncture where, you know, Carter Worth talks about this a lot. You know, you reach a critical juncture. You know, you see the stock converging, and it reaches a point, and he's not making a judgment about whether the stock's going to go much higher or much lower, only making the judgment that it's about to break in one direction or the other. That might be a circumstance where you would use a straddle. But in Lulu's case, it isn't reaching a critical juncture. The thing is just basically going straight down. So what are the levels I'm interested in? I want to see levels of potential resistance, and what is a fundamental level at which I'm willing to get long the stock and where it could find some support. So I would favor, if you're using straddles or strangles is the way I would go. Okay. Capital. I rather buy stocks. Okay, instead of close. Makes sense. Where were you 45 years ago when John Lennon died? I was in Peterborough, New Hampshire. And, yeah. So I was in Peterborough, New Hampshire, and one of my good friends was a huge fan of the Beatles, and we were actually in some musical play where we had it backed up by that. I was in grade school at the time. Adobe trade on earnings. I'm not a huge fan of Adobe. I feel like their subscription-based model is starting to tick people off. And this will be the last question I take very quickly. Let's just take a look at the implied move here. So it's implying a move of about 7%. See what the technicals look like. We'll just take a look at the chart. Yeek. What do they say? Nothing great happens below the trend line. The other issue is whether we're seeing some deterioration in the fundamentals and the growth rates. It's not terribly expensive. And still got good free cash flow. You know, I might take a, oh God. Yeah. I mean, here's the problem. I always get, I have to be really careful about this kind of thing, because I tend to get, it's only in a circumstance like this where someone says, hey, what about this? And I look really quickly at the performance, like, oh, that thing's getting kind of cheap. But it never hits my screens, because my screens actually would exclude this one for a host of reasons. So if you start to see the growth rate slowing, that would be a reason that it wouldn't. And in this case, it wouldn't meet my initial screen. My initial screen is I'm not looking at stocks that are below the 200-day. So this would, again, fall into that bucket that I was talking about earlier, which is my 20% special sits circumstance. Here's what I will say about it. The options prices look slightly elevated. And what we can see at this, look at this chart for a second. And one of the things you're going to observe is that this move has been, at the very least, fairly steady, right? So we don't see huge, big moves associated with earnings. And what that tells me is that that 7% implied move might be a little bit overstated, or at least something to be a better seller of, because it's not like it's totally blown the doors off in past earnings. It is below the long-term trend, so it wouldn't necessarily flag on my buy side, my buy contenders list by default, but its valuation isn't so terrible, and it is still growing, although earnings will tell us whether that actually holds up or not. But you can see here, I mean, this thing is anticipated to do, we'll call it $23, even if it does 20. So even if I handicap that number by 15%, you know, the thing is only trading at around 16 times adjusted EPS. So if they can just hold this number, and that is the top line numbers, you know, anywhere near that, and they can get anywhere near these numbers here, it is starting to look interesting on a fundamental basis. Technically, it's not there. Let's see if any short last look. See if any short-term technical indicators are indicating that there's a chance here. Let's take a look at this one. These two are about the same, but this one looks like it's a little bit short-dated in terms of its trading activity for me. Yeah. This thing has it as a buy, but very short-term. It's not something I ever look at, but you can look at it. And let's just look at the MACD, because that actually is a slightly slower paced indicator. And this has been profitable for what it's worth. So even in this downtrend, you can see these are the buy and sell junctures that MACD has come up with. I'll allow you to form your own judgments. I have not formed one of my own on this. But this is a technical indicator that has performed quite well over the course of the last year. It covered the short and went long on the 2nd. Stock is up a bit since then, but still on the long side. Okay, I've used up well over an hour of your time. For those of you who stuck around for this, I hope you found that helpful. I wish I had a more concrete answer for you on Adobe, but I mean, you guys know I kind of have a process that I follow, and if a stock doesn't land on it, although I might start to look and do a little bit of separate work on it, and I will here. ARM Holdings, by the way, somebody just asked me to do that, so I'm going to take another look at ARM Holdings too, but it doesn't meet my screens otherwise. So yeah, I'm not going to be able to answer this Peter Lynch question, but I will come back to that one either tomorrow with Mark Guthner if he's available, or on Wednesday when we do another open mic. Thank you all very much for watching. See you soon.